Okay, so you want to own a large farm. Buy thousands of acres, plant crops across the horizon, and let the sun, soil, and machines turn seeds into millions of dollars. Food demand never disappears. Land is scarce. Bigger equipment should make every acre cheaper to operate. That is the dream. The reality begins months before the first green shoot appears. Seed fertilizer chemicals, rent, wages, fuel, insurance, and interest must be paid or financed before you know how much the field will produce. Even after harvest, you may not know what the crop will sell for. A drought can cut the yield. A bumper crop across the country can cut the price. Trade policy can move your export market, and an interest rate change can make next season's operating loan more expensive. A large farm is not simply a collection of fields. It is a seasonal manufacturing company that operates outdoors, buys many of its inputs from concentrated suppliers, sells mostly undifferentiated products into global markets, and uses expensive land and machinery to produce inventory once or twice a year. The factory has no roof. Management cannot control the weather, and the selling price is usually displayed on a screen before the owner enters the room. That last detail changes everything. A branded manufacturer can sometimes raise prices when costs rise. A grain farmer normally cannot. If nitrogen seed repairs insurance or interest becomes more expensive, the elevator does not offer extra money out of sympathy. The crop is worth what the market will pay. Owning a large farm, therefore, means accepting a strange bargain. You control thousands of physical decisions, but the two variables that matter most, yield and market price, remain partly outside your control. Scale can make this bargain look attractive. In 2024, farms with at least $1 million in gross cash farm income represented only about 5% of American farms, according to the U.S. Department of Agriculture. Yet they produced roughly half of the country's agricultural output by value. Large-scale farms generated 51% of the value of cash grains and soybeans. Bigger operators can spread a combine grain cart accounting system, agronomist, and management team across more acres. They can negotiate larger input orders, keep sophisticated machinery busy, and justify technology that would be too expensive for a small operation. None of that makes the margin safe. It merely makes the machine larger. Start with the land. The USDA estimated that American cropland was worth an average of $5,830 per acre in 2025. At that national average, buying 5,000 acres would cost more than $29 million before adding a tractor, a bag of seed, or a grain bin. Location can double the number. Illinois cropland averaged about $9,850 per acre in 2025, which would place the same 5,000-acre purchase near $49 million. Better soil may support higher yields, but the price of that advantage is capital tied up in the ground. Most operators do not write a check for the entire farm. Some inherit land, some bring in investors, and many combine owned acreage with rented fields. Leasing reduces the purchase price, but it creates an annual obligation that arrives whether the harvest is excellent or terrible. The 2025 University of Illinois budget for high-productivity Central Illinois land used a land cost of $325 per acre. Across 5,000 acres, that is more than $1.6 million committed before the crop earns anything. Machinery creates the next barrier. A modern row crop operation may need high-horsepower tractors, a planter, a combine with crop heads, sprayers, tillage equipment, grain carts, semi-trucks, service vehicles, precision guidance systems, and access to drying and storage. A new combine, by itself, can cost several $100,000. Assemble a new fleet for 5,000 acres and the investment can reach several million. Buying used equipment lowers the entry price, but raises the probability that a critical machine fails during the few days when timing matters most. Then comes working capital. Corn needs seed, nitrogen, crop protection, fuel, labor, insurance repairs, and interest long before harvest. Soybeans require less fertilizer, but still consume cash for seed, chemicals, machinery, and land. For a 5,000-acre corn and soybean operation, several $1 million can move out during the growing season before most crop revenue moves in. This is why the lender is almost a silent partner. Land may be financed with a long mortgage, while equipment is supported by term loans or leases. A separate operating line pays for the season and is repaid after the crop is sold. USDA's Farm Service Agency offers direct and guaranteed programs, but its regular direct farm ownership loan is capped at $600,000. That can matter enormously to a qualifying family operator, yet it barely touches a $30 million or $50 million land purchase. A large acquisition normally depends on commercial banks, the farm credit system outside equity, seller financing, or some combination of them. Debt does something subtle to a farm. The land may be a long-duration asset that appreciates over decades, but the operating loan needs cash this year. A balance sheet can look wealthy because the acreage is valuable, while the checking account is under pressure. USDA defines working capital as what remains of current assets after current debts are paid. In 2026, the agency forecast that farm sector assets would rise, while sector working capital would decline. Those facts are not contradictory. A farm can become richer on paper and less liquid at the same time. Money is not the only gatekeeper. In the United States, there is no single federal charter that grants permission to operate an ordinary grain farm. Instead, access is fragmented. The deed or lease determines whether the land is available. Local rules affect buildings, roads, drainage, and grain facilities. Water rights and irrigation permits vary by state. Crop insurance and farm program participation require acreage and production records. Federal law requires certification for anyone applying or supervising the use of restricted-use pesticides, with states and tribes administering their own approved programs. Wetlands create another boundary. Normal farming on existing ground is often exempt from federal dredge and fill permitting, but converting or draining protected wetlands can trigger Clean Water Act requirements. The USDA's Swamp Buster provisions can also remove eligibility for certain federal farm benefits when wetlands are converted. In other words, ownership does not mean every acre can be reshaped at will. A low spot that looks like wasted space on a map may be legally, environmentally, and financially expensive to change. Once the farm is assembled and financed, the visible revenue begins with crops. On a Midwestern row crop operation, corn may produce the largest dollar sales per acre, while soybeans reduce nitrogen needs and help break pest and disease cycles in rotation. Wheat or another crop can spread planting and harvest windows. Specialty contracts for seed, non-genetically modified grain food-grade soybeans, or identity-preserved crops may add a premium, but they also add segregation quality and delivery requirements. Storage creates a second economic layer. Harvest prices are often weak when everyone delivers grain at once. Bins let the owner hold inventory, dry it to specification, and sell later when the local basis, the difference between a local cash price and the futures benchmark, improves. Storage is not free money. Bins cost capital, drying consumes energy, grain can spoil, and holding inventory ties up cash while interest accumulates. The advantage is optionality. The farm no longer has to accept the first buyer's price on the busiest day of harvest. Custom work can form a third stream. A farm with spare machinery capacity may plant spray, harvest haul, or dry crops for neighbors. The additional acres help absorb equipment ownership costs, but they also compete with the owner's fields during narrow weather windows. Finishing a customer's harvest while your own crop loses quality is a perfect example of revenue that can create a hidden operational cost. Government programs and crop insurance form a fourth layer, although neither should be confused with ordinary sales. Agricultural risk coverage and price loss coverage can provide support when program formulas are triggered. Federally supported crop insurance can pay an indemnity when insured yield or revenue falls below a selected guarantee. The coverage stabilizes a portion of the downside. It does not make every acre profitable, reimburse every cost, or remove deductibles. Accurate production history and acreage reporting matter because the guarantee is built from records rather than hope. Land can generate still another return, but it belongs in a separate mental account. Appreciation increases the value of an owned asset. Rent from wind turbines, solar projects, hunting rights, or a tenant may add cash in suitable locations. Selling a parcel can crystallize a gain. None of those items proves that growing corn or soybeans on the land produced an operating profit. Mixing land appreciation with crop earnings can make a weak farm operation look healthier than it is. The cost machine begins with direct inputs. University of Illinois budgets for 2025 estimated fertilizer, seed, pesticides, drying, storage, and crop insurance at about $486 per acre for corn following soybeans on high-productivity central Illinois ground. The comparable direct cost for soybeans following corn was about $225. Power costs, including machinery, depreciation, fuel, repairs, utilities, and equipment hire, added roughly $177 for corn and $159 for soybeans. Labor, buildings, business insurance, miscellaneous overhead, and non-land interest came next. Add those categories together, an estimated non-land cost reached $768 per corn acre and $490 per soybean acre. Land cost lifted the totals to $1,093 and $815. These are economic estimates, not invoices for every farm. An owner with fully paid land will have a different cash requirement from a tenant, while older machinery changes depreciation and repair expense. The budgets are useful because they expose the scale of the commitment. Some costs move with acreage. Plant fewer fields and the seed bill falls. Other obligations are stubborn. A combine loan, salaried manager, grain bin, shop, property tax bill, insurance policy, software subscription, and land mortgage remain even if poor weather prevents planting. Machinery depreciation does not wait for a good price. A normal year can absorb those costs. A weak year forces each surviving bushel to carry more of them. This is operating leverage in plain language. Once the farm covers its large base of committed costs, extra yield can be extremely valuable. When production or price falls, the same structure works in reverse. Agriculture adds another layer because the shock can hit both variables at once. A local drought reduces your yield, while a bumper crop elsewhere keeps the national price low. Crop insurance may soften the blow, but timing, coverage level, and actual production history determine how much protection appears. Supplier and customer power sharpen the problem. Seed genetics, fertilizer production, chemicals, machinery processing, and grain handling are each more concentrated than the population of farmers selling into them. A large operator can negotiate discounts, but cannot simply manufacture fertilizer when global gas prices rise, or repair proprietary electronics without the right tools and parts. At the other end, the local elevator, processor, ethanol plant, or export terminal may be one of only a few practical buyers. Grain can travel, but freight costs create a radius. The farm owns the crop. The buyer often controls the convenient route to market. The central trap is now visible. Costs are committed before yield and price are known. Rent is negotiated before harvest. Seed is ordered before emergence. Fertilizer may be bought before the market reveals the value of the resulting crop. Equipment is sized for acres that must be covered quickly, not for the average number of hours it works. As the operation expands, each decision that looked small per acre becomes enormous in total. Overpay rent by $40 on 20,000 acres, and $800,000 disappears before weather enters the story. Large farms often grow by renting one more tract, acquiring another operator, and adding enough equipment to keep the expanded footprint moving. During strong commodity years, this can look brilliant. Revenue rises faster than central office costs, machinery is utilized more efficiently, and lenders see valuable collateral. Expansion may even solve the previous scale problem. The danger arrives when growth is funded by short-term credit and optimistic assumptions. One poor crop weakens working capital, lower prices reduce the value of inventory and the borrowing base. Suppliers tighten terms, the lender asks for more collateral or declines the next operating line. At that point, the farm does not fail because the soil stopped existing. It fails because the seasonal machine cannot restart without credit. Borson Farms in Michigan shows how quickly that mechanism can become real. The operation expanded dramatically after acquiring much of Stamp Farm's equipment and operating assets through a court-approved sale in 2013. Expansion created scale, but it also required financing, leased ground machinery, seed, fertilizer, chemicals, and confidence from creditors. According to a later opinion from the U.S. Court of Appeals for the Sixth Circuit, the 2016 crop went badly. A poor harvest combined with falling crop prices and Borson entities could not cover their debts. Lenders and suppliers pursued unpaid obligations. Agricultural input supplier Helena Agri Enterprises ultimately obtained a judgment of nearly $15 million against several entities and family members. Equipment was repossessed, real estate was burdened by mortgage and judgment debt, and attempts to secure fresh credit for another season failed. The court summarized the fatal point in almost mechanical terms. Without financing, the operation could not conduct farming operations. The fields were still present. Knowledge had not vanished. Demand for food had not ended. Yet the machine could not buy the next set of inputs or deploy the equipment needed to begin again. Porcine farms also faced other creditor disputes and allegations, so the case should not be reduced to weather or commodity prices alone. Its value as a business lesson is narrower and more precise. Rapid acreage growth can create revenue without creating resilience. When weak production, lower prices, creditor claims, and lost access to funding collide, size stops protecting the farm and begins multiplying the amount that must be refinanced. Success at scale looks different. Consider SLC Agrícola, a publicly listed Brazilian producer that traces its agricultural operations to 1977. The company farms soybeans, cotton, corn, and other crops across a vast footprint, using owned land leases and joint ventures. Its advantage is not simply that it plants more hectares. Geography spreads weather exposure, crop diversity changes the revenue mix, second crop planting increases land use, and a seed business adds another layer beyond commodity production. SLC's 2024 integrated report recorded approximately 661,000 hectares of planted area. Net revenue was about 6.9 billion Brazilian reais. Adjusted EBITDA reached roughly 2 billion reais, with a margin of 29.4%. EBITDA means earnings before interest, taxes, depreciation, and amortization. It is a view of operating performance before financing, tax, and major non-cash capital charges. Net income was far lower at about 482 million reais. The difference matters. A successful farm can report strong operating earnings while still consuming large amounts of capital. SLC reported only about 34 million reais of adjusted free cash flow in 2024, as expansion and investment absorbed cash. Its results also shifted by crop record cotton volumes supported the year, while soybean and corn performance weakened. Diversification did not eliminate agricultural volatility, but it kept one crop from telling the entire story. Underlying advantages helped. SLC operates in regions where large contiguous fields, multiple crop cycles, and professional systems can reward scale. Central purchasing, technical teams, hedging storage, logistics, and data become more useful across hundreds of thousands of hectares. The company can also separate the economics of farming from the economics of land, measuring operating results while tracking changes in property value. Still, no result should be credited only to management genius. Brazilian agricultural expansion infrastructure development, global demand for soybeans and cotton, suitable growing regions, and decades of accumulated operating knowledge all supplied the tide beneath the business. Scale worked because it was paired with diversification, access to capital, process control, and a revenue mix broader than one harvest in one county. Now place yourself inside a simpler one-year model. Assume a 5,000-acre farm on productive rented ground in central Illinois. Half the acres grow corn after soybeans, and half grow soybeans after corn. The figures are illustrative, rounded, from realistic 2025 university crop budgets rather than taken from a specific company. At 236 bushels per acre and a realized price of $4.70, the corn produces about $2.77 million. 75 bushels of soybeans at $11.20 generate another $2.10 million. Add $150,000 from custom work storage and minor program income, and total revenue reaches just over $5 million. Non-land production cost is approximately $1.92 million for the corn acres and $1.23 million for soybeans. Rent across the full operation adds roughly $1.63 million. After those economic costs, about $250,000 remains. That is a 5% margin on revenue before any surprise not captured by the model. On 5,000 acres, the farm looks enormous. The reward for the year is thinner than the sales figure suggests. Change one variable, realize crop prices fall by roughly 10% while yields remain the same. Corn revenue drops by about $277,000, and soybean revenue falls by roughly $210,000. The $250,000 profit becomes a loss of more than $230,000. Seed has already been planted. Rent does not reset itself. Machinery ownership costs remain. Producing the expected number of bushels was not enough because the value of each bushel changed. A yield shock creates a different path to the same problem. Crop insurance may generate an indemnity, and good marketing can protect part of the price, but neither tool perfectly matches every acre and every cost. Hedging too much before a drought can force the owner to buy back contracts when physical grain is missing. Hedging too little leaves the crop exposed to a falling market. Risk management is not a button marked safe. It is a series of trade-offs between protection, cost basis, production uncertainty, and cash timing. Technology will push this business further toward scale. USDA data show that in 2023, auto-steering guidance was used by 70% of large-scale crop farms, while yield monitors, yield maps, and soil maps were used by 68%. These systems can reduce overlap, save fuel and chemicals, document field performance, and help vary seed or fertilizer by location. Autonomous machines, satellite imagery, artificial intelligence, and better weather models could let fewer people manage more acres with greater precision. The advantage will not be distributed evenly. A tool that saves $5 per acre creates $25,000 of value on a 5,000-acre farm and $500,000 on 100,000 acres. That gives the larger operator more reason to pay for software, sensors, connectivity, and specialists. At the same time, dependence on proprietary data platforms, dealer, service satellites, and electronics creates new supplier power. The tractor may become more productive while becoming harder to operate outside its technology ecosystem. Climate volatility adds pressure in the opposite direction. More precise management can improve decisions, but it cannot guarantee rain, prevent every flood, or cool a regional heat wave. The farms most likely to endure will not necessarily be those chasing the maximum yield every year. Strong liquidity, geographic or crop diversity, manageable rent, flexible machinery capacity, storage insurance, and patient capital may matter more than winning a single season. This does not mean a large farm is automatically a good or bad investment. Location, soil, water, financing, management, regulation, crop mix, and entry price change the result, and new filings or market conditions can change the figures. The purpose here is to explain the machine, not to provide personalized financial, legal, tax, accounting, or investment advice. Owning a large farm can create several forms of wealth. Operations may earn cash. Land can appreciate. Scale can improve purchasing logistics and technology. Storage and marketing can add optionality, while a strong balance sheet lets the owner survive years that force weaker competitors to sell. Those are real advantages. They exist beside an equally real contradiction. The asset beneath the business may grow more valuable, while the act of farming it loses money. A field can be excellent collateral and a poor source of current cash. One season can produce millions in sales, employ sophisticated machines, and still fail to cover the full economic cost of land capital and risk. At the beginning, the proposition looked almost effortless: buy thousands of acres, plant the horizon, and let food demand do the rest. What you were really buying was a leveraged seasonal factory with no roof, a global selling price, and one narrow window to turn uncertain biology into cash. You thought you were buying a large farm. You were buying thousands of acres of uncertainty before the first seed ever entered the ground.